Good morning, everyone, and thank you for joining us today. So it's Jeremy Palmer here. I'm the Head of Financial Policy at the BSA, and I'm joined today by Oivind Andresen, Director at BDO, whom we are very pleased to welcome back to present to us. And also a big welcome to all our members. I think we have, when everyone's finally logged in, we have just over 90 delegates today. So the first thing I wanted to say is from all at the BSA, we hope you and your respective teams and all your families and friends are safe and well as we're marking the anniversary of lockdown. I just want to touch on a few housekeeping points next. So today's webinar is going to be recorded and we'll circulate the slides and recording in a few days' time. Your lines will be automatically muted throughout the webinar. You can imagine with 90 plus, all the background noise and so on would be quite challenging. So you'll all stay on mute throughout the webinar. Please submit your questions to the panel through and the panel really means Oivind, through the session using the Q&A function, which you should find on your screen, sort of more or less at the bottom. And those will come up and we'll review them and work through them. If you have technical problems, you can use the chat function to contact either Rima Stevenson or Lara Bradley, who are our Masters of Ceremonies today. And just to mention, by the way, happy birthday this week to Lauren Hughes from BDO, who's done some of our previous webinars, who's away. So just moving on, I mentioned in the write-up to the webinar that there are currently what you might call noises off about quite what will happen to Basel IV. There's been a lot of pushback in Europe for further delay. And while we were preparing for this event, we were hit by the colossal CP 521 with its hundreds of pages of annexes. And it takes a bit of time to work out that that is all to do with the previous batch of stuff, what you might call the last gasp of Basel III. So Oivind is going to go through the impact of CP 521 first, because that will hit you sooner, and then cover the slightly more distant Basel IV. Now, I don't think I need to say more. If you thought you'd ended up tuned to a horror channel, don't worry, it's only Basel IV. It's all quite ordinary, so don't adjust your set. Do make sure you're sitting comfortably. Ignore the creaking floorboards and the muffled screams while I hand over to Oivind and I resume my resting avatar as Red Panda. So Oivind, the floor is yours.
Thank you very much, Jeremy, and good morning, everyone. And thank you for inviting me to talk here, again at the BSA. I'm very excited. As Jeremy said, this I'm not sure if it's a horror story we're covering today, but there's certainly been some moments that are, I wouldn't say, it's pleasant, given that the way this all has panned out over the last couple of years and what we're looking at sort of going into the future. So what I want to cover today is just, I think it will be incredibly helpful to give everyone an overview of in terms of even the timelines, what's CRR2, what's CRR quick fix, what's CP 521, what's Basel 3.1, what's Basel 4, how do all these things fit together, and sort of what has happened in light of this and Brexit and what's going to happen going forward. So that's really where the plan is today. It's really to sort of to start with the current changes that we see coming up, and then sort of end up, with the Basel IV proposals, and then we'll have a sort of, like Jeremy said, a 15 minutes or so at the end for for Q&As. So it's a bit of a tour in terms of what's happening. So what I will do first is I'll take you through the timelines here. So you can see this arrow really sort of starts back in Q4 2020, where when we had the implementation of the CRR2 quick fix. I think that came into regulation on the 23rd of December, although it was announced earlier back in June. And this touched on things like the software assets deduction that you don't no longer have to do. But then, as we all know, the PRA has reintroduced that, and they do talk about that in CP 521. But that was the kind of where we were at the end of the year. And then you see there was a dotted line, and that's the end of the EU transition period. So everything from a regulatory sort of PRA perspective that happens after December 2020, does not have anything to do with the EU. The UK sets its own rules, etc. Although, of course, it has to consider the EU rules and CRR2. So the first sort of checkpoint there is really, which we saw in February, was the PRA's consultation on implementation of the Basel III standards. This is the CP5 21, and that's sort of the mop-up of the remaining sort of initial Basel III changes. The kind of some of them, in CRR2, so they do comment on the PRA's take on those, and also some of the other ones that didn't really manage to get into CRR2 on time. So that's what this CP521 is about. So I will cover that in some detail. Then we have in June 2021. That's when the CRR2 will be implemented supposedly in the EU. I think it has to, because it's sort of enacted into law, etc. But that doesn't really impact the UK directly. The key deadline for UK building societies is 1st of January 2022, when the CRR2 changes and then sort of Basel III changes will be implemented. At least that's what CP521 is stating. What you will see further to the right is that the PRA has also committed to implement Basel 3.1, or Basel IV, as I think it's known by most people, and that's supposed to be implemented by the 1st of January 2023. I've highlighted that in red and put loads of question marks, because there's still a lot of challenge on that, I think, from various sides. Although the PRA, and I actually I spoke to them yesterday, sort of committed to, that's their party line at the moment, 1st of January 2023. So if you see sort of at the bottom of the slide you have in front of you, you'll see the PRA has committed to a consultation on Basel IV and these changes, and which will happen during 2021. So we don't know when exactly this will happen this year, but certainly there'll be a consultation. So that's where the kind of last parts of Basel IV will be pulled out. So what I will go on to do now is just spend a bit of time talking through kind of CRR2, the CRR quick fix, and CP521, and talk you through how the UK will implement that. So on my next slide here, I have a sort of a summary of the key changes. So the ones in the sort of boxes at the top, if you like, that's CRR2 and CP521 related. It's all the stuff that will go live 1st of January next year. At least that's what the regulators have committed to. So some of you may be familiar with this. Some of this is in the CRR2. Some of it is not. And then at the bottom here, which I'll sort of spend the last part of this morning's presentation on, is to talk about the Basel IV change. This is the wholesale, risk weighting changes for standardized mortgages, etc., and so on, and IRB floor. So quite a big change. However, saying that, I think it's useful just to talk through some of the key changes that we have in CRR2 as well, and how that will happen. So we all know about capital and the sort of software assets deductions, which is now back on the cards. It was previously treated as an amortized risk weight in the CRR, but the PRA has very clearly said, actually, you need to deduct your software assets. There's some changes to the non-performing loans backstop. We have for credit risk, if you have CIUs, I don't think that many building societies have, but if you have any CRU sort of equity exposures, like in any fund investments or anything like that, like business growth funds and so on, then there will be some changes to the treatment. We also have, new supporting factors for SMEs. The regulators have also clarified for operational risk some of the treatment for operating leases shouldn't have much impact. I'll touch on that. Counterparty credit risk. This is a big change for UK regulated firms, but I don't think it has much impact for building societies at all, given that most of you probably have a fairly small treasury book where you have a bit of derivatives. It shouldn't have an impact, but I will touch on it because there will be some impact. Large exposures, there's changes around what's considered to be capital for large exposures, just tier 1, not only tier 2 capital. For regulatory reporting, there are significant changes. Some of you may recall I spoke to this forum last year around EBA 3.0 taxonomy and the new regulatory reports. So the PRA has committed to those, and I'll touch on that later, although with a UK twist on it. On liquidity items like LCR and NSFR, there's some changes there around sort of outflow rates and the simplified regime. Our Pillar 3 disclosures will continue to evolve along with the regulatory reports, and there's new thresholds as well. So that the PRA is stepping away from the kind of euro-based EBA thresholds for and currency denominations and move that into sterling. And then on Basel IV, I'll talk about the new risk weights. I'll talk about the new operational risk calculation. I'll cover IRB floors and model restrictions. I will also touch briefly on market risk, very, very lightly, and then just on regulatory reporting. I'm not going to cover MREL at all. I know that's quite a big impact for some of you and drive some of your capital requirement, but that's not really in scope for this session. But I am aware of that will almost trump some of the challenge you have from a capital perspective. So if we move on to my next slide, I just want to touch quickly on the CRR2 quick fix. So this was implemented, as I said, as it was rushed through as part of the kind of COVID package last summer. It was quite helpful for firms with exposures to SMEs. So if you have an SME lending, you could get a slightly higher or a better, effectively, discount on your capital. This rule introduced non-deduction of software assets. However, and this is really important, the CP 521 states very clearly that the PRA is not going to accept that firms deduct software assets from CET1, not deduct the software assets. So they've written, I think, to CEOs of banks. So I think you just have to be prepared if you would make this change last year that you have to to get it back. And I think they've talked even about if you still do it for Pillar 1 purposes, they may give you a Pillar 2 add-on, and they're just encouraging firms to do that. So there's no benefit at all for software assets. They did reset IFRS add back. So if you're an IFRS 9, you could add back the transitional provisions. So you'll see at the bottom here that there were some benefits, although not for capital deduction. I think that's the headline there, and it's really important to note that CP 521 does not allow software assets to be deducted. So that's the first sort of post-Brexit change where the PRA is taking a different view from the EBA. I can't stress that's really important. And the reason why the PRA is saying this is that actually the software deduction is not really part of the Basel rules. So the kind of the Basel Committee's rule is something that the EBA and the European regulators have done just specifically for their members. So the UK is no longer part of that, so it doesn't have to to deal with it. So PRA has been very clear on that, and it's been in the papers, etc. So just want to to watch out for. If we move on to the to the next slide here, just want to touch on there's some changes to non-performing loans as well. So basically, what's happened here is there's an introduction of a backstop. So if you haven't really provided and haven't enough cover for your non-performing loans, then the regulators will put in a floor which you have to deduct any amount that's not covered by this minimum amount. And this amount is quite straightforward to calculate. It looks at your exposure value, and then it looks at what they call the coverage requirement factor. And this factor is based on, how much is unsecured, what bucket is it, what type of security is it, and so on. So this is something that firms would have to observe. For most of I guess the smaller banks and building societies I've spoken to, this is not really an issue at all. Most firms tend to have enough coverage for their assets. I'm only aware of one bank in the UK that have an extra deduction for this backstop regulation. And it's also, I think, for new loans only, so 2019 onwards. What you will see here, though, and I think the impact is that there are new co-rep reporting templates for this. So again, there's more for your regulatory reporting teams to look at. So I think that's really the main impact here for building societies. If we move on to some of the credit risk changes, I did talk about briefly, just mention around the new supporting factors. So if you have infrastructure exposures to hospitals and those things, you will have a new beneficial supporting factor. I'm not sure how applicable it is to building societies, but I think it's good to be aware of that. Probably more relevant for the audience today is the SME exposure supporting factor. So if you have exposures less than €2.5 million, you'll get a supporting factor, and also for SME exposures greater than €2.5 million. You'll see there's some changes here. There's also new rules on collective investment units. I don't think that applies very much, but if you do have those, just know that the rules are changing, and also there's equivalence rules as well. So if you have them in those exposures in another country, then there may be a change. So I think that's all I want to say about that. There's also additional reporting requirements around this in the co-rep templates that you have to look out for. So that will come through in the new EBA 3.0 PRA version of that. Just for firms to note. Counterparty credit risk, again, as I mentioned earlier, I don't think it's particularly relevant or has a huge impact for firms here today, so I'm not going to spend a lot of time on it, but I think it's important to note that there are new thresholds for counterparty credit risks, and the PRA has converted them into sterling, as you see here. So for example, if you do have derivative positions, you can either choose a simplified SACCR calculation or the original exposure method if you're less than either 10 or 5% of your total assets respectively. So I would imagine most building societies, with some exceptions, would fall into that categories. So this means that you have to do a new calculation if you do the SACCR, and it's a little bit more complex than the current CEM method, and it's driven by replacement cost, potential future add-on, and netting. So I think if you are in that territory, just make sure that you'll follow that calculation. Again, I don't think it's a huge issue for building societies. You'll see it's a bigger impact for other firms in the UK banking industry, but not for building societies. And there's new reporting templates that you all have to complete as part of that around CO7 and CO8. There's changes. So even if it has a limited impact, you still have to report it. One I think that's a bit more relevant to the firms here today is that your large exposures. So the way large exposures, the capital base for large exposures is being restricted. So previously, large exposures was based on eligible capital, which was a combination of Tier 1 capital and a third of Tier 1 Tier 2 equal to Tier 1. So sort of Tier 1 and a little bit of Tier 2. that is now just being replaced by Tier 1 capital. So this will impact firms if you have a lot of Tier 2 capital. Again, I don't think many building societies necessarily have, but if you do have, then you will have to change your large exposures calculation. So and you also see there's some changes in terms of if you have exposures greater than 300 million, for example, you have to report them, or 10% of your but less than 10% of your capital. But I think for building societies, the impact here is that just make sure that you calculate the capital correctly, the capital base. It's as simple as that. Another change probably will impact you more on the CRR2/CP521 is you will have NSFR is finally coming into sort of a reporting format, and the key thing here is that you have to check first if you are identified as a small and non-complex firm, which is defined in the CRR in Article 4.145. So I think there's about 9 criteria that you have to look at. And the reason why you have to look at those criteria is that drives which templates you're going to use for NSFR. So if you're a small and non-complex firm, you can use the simplified reporting templates C82 and C83, which makes it easier to calculate. I mean, there's 9 criteria here, but I think the ones for you really to consider are the ones also drives it is the balance sheet size. So if you have balance sheet less than 5 billion, which I think most building societies probably do with some exceptions, then you can use a simplified template. So there will be new templates for everyone, but you can use them as simplified if you meet the criteria. So again, there's something that firms have to look out for. On market risk, again, not so relevant for building societies, but I thought it's useful here to know that there's derogation for small firms that you can use your credit risk framework to calculate own firm's requirement if you have a trading book. If you don't, then there's not much impact at all, apart from that you will have to report 2 new templates around, which is called C90 and C91. So there'll be regulatory reporting requirements, but there wouldn't really be any changes to market risk if you calculate any market risk at all. The old sort of the minimis market risk rules still apply. So again, that's something for firms to consider. So I'm not going to go through much detail. I just wanted to let you know that there are changes here that you'll have to pick up in your sort of regulatory reports. What things that will change quite a bit is the kind of the regulatory reporting and Pillar 3 disclosures environment. You'll notice that I have so far this morning talked a lot about sort of every sort of risk change, if you like, has a new regulatory reporting template, and I've made the references to COREP and FINREP. So the PRA has stated that they they want to onshore COREP and FINREP, so they're using the same sort of templates. However, they will look to to make sort of PRA specific changes to that. So they have said that, yeah, they're going to adopt the EBA 3.0 taxonomy, to be consistent. But I would imagine over the years there'll be UK specific changes to this, as you can imagine. Excuse me, but at the moment it's very much pretty much adopting the EBA templates and just changing some of the naming, etc. I think there's a couple of changes in the templates. If you're looking at, if you want a sneak peek of the new templates, you can look in CP521 in one of the appendices, but it's very sort of COREP-y similar to that. So I think that's just for firms to look at. There will be new regulatory reporting, additional costs and resources as a result. There are also new Pillar 3 templates You may know that Pillar 3 is very much becoming more and more standardized and prescribed. So basically, CRR templates will end up in your Pillar 3, disclosure, sort of similar. So this very much follows on for that they expect new templates to get into firms' Pillar 3 returns. So that's, I think, all I wanted to talk to you about the kind of the CP 521, give you a whistle-stop tour. As I said, I don't think there's any huge changes for building societies in CP 521, but there's quite a lot to, I guess, to plow through and be aware of, and also be aware of the new EBA 3.0 PRA's take on those templates for your regulatory reporting teams. If we look on the kind of Basel IV, and you see here in brackets, I put 3.1 because the PRA refers to, and the Bank of England and Nation Treasury refers to Basel IV as 3.1. So that will be used interchangeably, and you'll see that being used interchangeably as well in various communications. I think when people mean Basel 3.1, there is effectively Basel 4 as well. Don't ask me why they use this interchangeably, but I think it's important for people to know. I had some really busy slides here, but what I'll just have in front of you here is there's a couple of key things which I think will impact firms with an IRB permission. So IRB permissions, for those of you who don't know, is the kind of, you can calculate basically risk-weighted assets using your own models. Something that's really important here is that there's the introduction of a capital floor, which is basically will be 72.5% of standardized RWA. So I have an example here, which I've taken from the Basel Committee's website, where we have a firm, so they have an IRB firm, so they have total RWAs of 76. Which is is calculated presumably by their IRB models, or in most instances here, some of them are not modeled, but in most instances it is modeled. And then you have that calculation reperformed using standardized risk-weighted assets, and you'll see there's a huge difference here of between standardized and IRB, so 140 and 76. What the floor is saying is basically that you have to floor the pre-floor RWAs at 72.5%. So the 76 on total RWAs, actually you're not allowed to report that anymore. You have to add on an additional 25.5 basically to get to 101.5, and the 101.5 is 72.5% of the standardized RWA. So this will have quite a big impact for firms on an IRB model, particularly if there's a huge discrepancy between for asset class, and where there's a huge discrepancy between IRB and standardized. I think one to pick particularly, I think, for building societies is obviously the residential mortgages. And I think we've started to see a journey towards that, where the PRA recently have introduced, I think, CP 1420, where it talks about introducing floors for risk-weighted assets for models on, I think it's 7% for portfolio individuals, and then 10% for portfolios, I think. So just to sort of starting that journey, so you can see where the regulator is coming from, that they're just pushing firms towards having RWA's floor. Reason for that is I think the kind of the average IRB risk weight for mortgages, for residential mortgages, I think is it's in the low 10s, I think, and then obviously for standardized the RWA weighting is 35%. So you can see sort of how this floor will impact that. I'm sure the bigger firms have already modeled this, but it will have an impact. Perhaps not as much as MREL, which I think is another key driver for for the larger firms. But it's definitely something to to look out for. The capital floors. You also see I've added here the kind of if you're an IRB firm, what are you allowed to use in terms of approaches. So I've highlighted what they refer to as Basel III approaches here. So, for example, if you have exposures to banks and other financial institutions, you're not allowed to use an advanced model anymore. You have to use the foundation internal model or the standardized model. Same with exposures to large and mid-sized corporates and other things like specialized lending, for example. There's certain restrictions on that. So you can see where the regulators are going. They're restricting the use of the IRB model. There's also other things there around, for example, lifting the PD floor as well to 0.05. So in the past, I think that's been as low as 0.03. So for some firms, this will have an impact. So that's really the kind of what these changes are for IRB firms. So quite significant, I would say, although probably slightly less than the MREL changes. If we just move on, and this slide here will probably interest most of you here today. You'll see there's sort of changes to the standardized exposures. This is probably quite well known among most of the firms here today, but there's obviously a big change for residential real estate lending. Whereas we in the past just have had a sort of a 35 all the way up to 100% risk weight for mortgages based on the kind of 80% LTV. Now this is becoming much more sophisticated, where we're having LTV bands, from less than 50 up to greater than 100, and you can see, the risk weights are lowered from 35 at the moment down to 20, and then, if you have more than 100% LTV, is 70%. So favourable for the kind of residential mortgages where people actually going to live in the property, and then it splits out for work in instances where you have income producing residential real estate. So there's a new asset class for that, and this is effectively buy to let. So you'll see there's different risk weightings for the buy to let portfolio, starting from 30% up to 105, whereas in the past it's just been sort of a 35% up to 80% LTV, and then different above that. So that's really I think quite a big change. And some of the building societies I've spoken to, they're quite sort of excited about this and trying to work out how will this impact their portfolios. What we also have here is there's heaps of other changes to the risk weights. Some of them probably wouldn't have so much impact on building societies, but basically, if you have very risky, exposures, like things like equity and other things that are not particularly liquid, the risk weighting is going up for those. So, for example, equity exposures that you don't deduct from capital. So if you have an investment in another entity, for example, that will get a 250% risk weight. Now, at the moment, that's had 100% risk weight. So again, that will I think will drive some increase for some firms. Perhaps not so much, but I think enough for some to make a difference. And you'll see there's also that can be as high as 400% if you have unlisted equity exposures. Again, I don't think how relevant it is for firms there today, but it's useful to be aware of that. You also know that in the bottom left on this slide, I have a couple of bullet points, and this is around rated counterparties. So I think for building societies, probably the ones that are relevant for you are your exposures to to other banks and institutions. So for example, you have some placements with other banks and some cash placed with other firms that are rated. The kind of the ECI sort of rating table, so where you look at the risk weighting for for these banks is is changing. So, for example, if you have an exposure that has a A+ or an A- rating to a bank, it doesn't get a sort of a 20% risk weighting anymore. It will get a 30. So that table is changing slightly. So I think when this comes in, it's very useful just to look at your kind of treasury exposures as well, and to see which risk weighting will we get. And there's also a few tweaks to other asset classes. So, for example, for retail exposures, they're introducing a new 45% risk weight for certain retail exposures called transactors. And what they mean by transactors are, I think the best example here is probably a credit card, where you have a credit card where the customer is actually paying the bill every month, and if you have that sort of customer profile, so the credit card is paying, then you can treat that as a transactor, and you can apply a 45% risk weight as opposed to a 75% risk weight. So loads of things I think to unpack there and go through in the rules. So and what I've just done here as well is the tables. I've just put in some sort of pros and cons, if you like, of what the changes will be. So I think for most building societies, if you have a very high quality sort of mortgage book in terms of low LTVs, you will benefit, and it may create an more even playing field where the kind of the risk weights will go up for firms with IRB firms, as I said, because there's floors, etc. So that's I guess that's good, and also around things like clarification of definitions and more sophistication makes pricing more transparent. And I guess the flip side of that is around negative aspects. We have for firms with IRB, there's big change, as I mentioned several times, floors, model restrictions, and so on. Again, I just think you have to weigh that up against the kind of impact of MREL, which I think is significant for some of the firms here today.
Oivind, can I just interrupt for 1 second, because there's several questions on the same broad topic have come up both through chat and through Q&A. I think it's exactly in this area. So rather than come back to it at the end, I thought I'd just give you a chance to have a sip of coffee, and let's deal with the question now. It relates to residential real estate exposures and the question of valuation, and whether you have to do original valuation, or whether if you do a kind of change of product or some other situation, whether you use a current valuation or you're stuck with original valuation all the way through. And I know that's been a bit of a contentious issue, and we think it's a bonkers idea, but just wonder whether you get any indication from what you've heard from PRA which way they might want to jump.
That's a really, really good question. I think that's one that I've heard sort of people that I've spoken to has asked as well, particularly some of the the smaller banks. So I haven't heard any sort of signal from the PRA around that. I must admit I haven't, and I couldn't, when I sort of looked at the kind of for any in CP 1420 to see if there was any sort of insights there. I couldn't see much, but I think it's a big impact, potentially a very big impact for the firms. I think those are the kind of I think you use the analogy of horror stories, Jeremy, in your sort of introductions. I think that's one that will have a huge impact on the firms, and I don't really know what the impact will be, but I think we just have to be very careful and look and and lobby as well. And not it's a bit of a I don't know, to be honest, where they're going to end up, unfortunately. But it's a really good question. So I think it's one we have to look out for and plan.
Okay, back. Sorry, sorry to interrupt you. Continue.
And if I hear anything around that more, sort of, I will of course share that with you. But yeah, I think it's a great question. I think that just sort of summarizes some of the stuff we have on the credit risk side. There's some positives and there's obviously some negatives as well around the models in particular. But I guess it's an opportunity for firms to look more carefully at their books and plan accordingly. Just finally, I want to touch on the operational risk calculation. So there's a new operational risk calculation as well, and you look at this slide and I think it looks a bit daunting. There's some formula here, and what's going on. I think the key thing here to take away from operational risk is that the way it works is that the current BIA approach, so the business, sort of the basic indicator approach, the standardized approach, which if you can see the slide, I hope you can. There you go. Goes away, and it's being replaced with this new standardized calculation. And you see there's sort of 4 steps here. I think from building societies, as long as your business indicator, so effectively your income, as long as that's less than 1 billion euros, which I think for most firms it will definitely be, the operational risk requirement is just literally that business indicator times 12%. So it's a bit like almost whatever you have at the moment when you use the basic indicator approach and you apply 15%. However, if your income is more than or your indicator is more than 1 billion euros, then you will have to apply loss data as well. So this is where things start to get really complicated, and that's what step 3 here is. That basically you and steps 4. So you have your loss data and your loss multiplier. I mean, I haven't looked at the kind of income and calculated the business indicator for any building society, to see if there's anyone that will hit the sort of 1 billion threshold. But if you do, there will be a step you have to take where you have to take your loss data and put it into this formula, which you see here. But I think, and this is important for most firms, this loss multiplier is equal to 1 if your sort of business indicator is less than 1 billion. And what I mean by business indicator is really the kind of similar to what you have at the moment. So gross income, etc. Plus there's a sort of a lease and dividend component where they look at your assets, your interest earning assets, and takes 2.25% of those. So we'll look at your balance sheet and take 2.25% of the balance sheet as well, and add that on to the to the income. So not just pure income that you have at the moment. So I guess that was probably what can drive perhaps some of the firms with very, very big balance sheets above that 1 billion threshold. But I think it's for most firms, you will end up with a business indicator component equal to less than 1 billion, and you therefore just have to apply a 12% a weight to to get your capital requirement for operational risk. So I think it tries to simplify it, and I think it does for most firms. If you're a really big building society or a large bank like a Barclays or whatever, then this loss data will come in, and you have to go and look at historical operational risk losses, etc. Sounds quite difficult and challenging, but it wouldn't apply to to most firms. So I think that's probably sort of summarizes and concludes what I want to talk about this morning. I'm just going to go back to the slide that we started on here, where you can just see the timeline. But I think that's important for you to say how this all pans out. So we have, there we go. Yeah, so we have, the CRR2 CP25 going live 1st of January 2022, and then Basel 3.1/4 will be implemented in 2023. So there's a lot of things for firms, to do. And I know from some of you there's interim steps like a CP 1425 around IRB mortgage risk weights, for example. So there's a really busy period. So yeah, but I thought it's useful just to have those timelines, so you know what the key changes are and what the impact is, at least at a high level. So that's, I think, everything I wanted to to talk about today. I think we have time for questions, so I'm going to hand over to Jeremy.
Okay, thanks, Oivind. That's really useful, and I'm delighted to say we've got nearly a dozen questions which have come up in the Q&A. So because the questions, I think on this system, they're not automatically visible to all the delegates. The easiest thing is I'll kind of read them out. So I'll be the question master, if you like, and Oivind will be in the mastermind chair and answer them. So I think the easiest thing is to go through them more or less in the order they came, which will be based on the order that you took us through the material, Oivind. So we're starting really with CRR2 related stuff. And there's a question from Laura, first of all, saying, are the new Pillar 3 disclosure templates expected to be applicable to all institutions? Because currently they only apply to GCs or GSIBs.
That's a really good question. So yeah, so I think some of these templates apply to GSI, so the whole thing, the whole sort of suite of hundreds of templates. But there will be some of them that will apply to to smaller firms, depending on your size as well. So I think you need to look out for that and make that assessment whether whether you're in scope for them or not. So I think that's based on things like balance sheet size, etc. So yeah, there will be some changes to the Pillar 3 templates for everyone.
Oivind, I remember something which I thought was going to come in CRR2 for small and non-complex banks, where the Pillar 3 was really cut right back.
Yeah, exactly. So it is that threshold, I think, around 5 billion euros. I think that's the kind of the small and non-complex. So if you sort of are on, it's whether you meet or not meet that requirement, that will make it easier. So that will cut the Pillar 3 right down. But if you're above that, which I think some building societies are, then this will apply.
Okay, good. Next one was from Graham, who asks, are there any reasons why the non-performing loans and the SME and infrastructure supporting factors and IFRS 9 relief reset aren't particularly mentioned in CP 521?
That's a really good question, and I sort of looked at that as well and thought, why isn't it's sort of specifically mentioned? I think it's because some of these changes were sort of went into I think because it went into UK law prior to the transition period. So I think the PRA say that that's already happened. We have to implement it, etc. Although the timing for that is obviously with the new COREP templates later on, but it's I think that's the reason for that. But I think it's a really good question, because I struggled a bit myself to understand exactly why why it's not sort of explicitly mentioned. Why don't we just summarize everything that has been implemented and not? So yeah, really good question.
I had one sort of related question on the SME and infrastructure factors, because I know that in the past PRA hated them, but they had to put up with them because they were EU. So I just wondered, is there any sign that PRA now want to diverge and not have them?
It's a really good question. I think and I need to check the sort of the depth of the Basel 3.1 rules, but I'm pretty sure that they do refer to some SME factors in that legislation. I think we have to come back to confirm that exactly, but I suspect there's some there are references to the SME factors in that.
Good. Question from David Ross. The NPL backstop. Do you think there could be an issue with IRB definition of default if accounts fall foul of definition of default due to unlikeliness to pay, but continue paying, so technically show as non-performing over time, despite actually maintaining payments?
Really good question. I think yes, there probably could be an issue with that. I mean, it depends on I think the kind of the shape of your book. But for example, if you are UTPs that unable to pay, but you are continuing to pay, yeah, you will be non-performing, and despite maintaining the payments, absolutely. So I think that's one way you will have that inconsistency. Definitely, it's a technical default, I think, rather than an actual sort of economic default. So yes. Yes, I think you will be caught by that. Yeah.
Question from Lizzie. It sounds as though there are quite a few, say this again. It sounds as though there are quite a few new templates. Will there be an immediate cutoff or phasing out of old templates being replaced, assuming that some will be retired?
Yeah. Yes. I think the kind of the way this works is normally when there's like a sort of an EBA release of new templates, just a wholesale change. But the many of the templates will just be exactly the same, but there will be new fields. So normally the way this works is that your sort of software provider, they'll sort of tell you what those changes are and send you new templates. But yeah, so I think it's there will be changes. There will also be, I think also the PRA has provided some transitional templates as well. So where they will apply transitional provisions, I think for they will be in there. So there will be, I guess, a slow approach, but you will see a lot of templates being carried forward.
But is it true, just picking up on Liz's question, that where there's a new template, that the equivalent old template is retired, or they're not having to sort of parallel run new and old? No. Okay.
No. I think there's just new templates, but I think for Lizzie, there's if she goes into CP 521, there's the PRA has set out all the templates, so you can easily see it there. But yeah, I think it's just, for example, for NSFR, there's just new templates, and the old ones are being chucked away. Thank God. Yeah.
Okay. Good. Yeah, we like that.
Yeah.
Question from Victoria. On the new Pillar 3 templates, for firms with oh goodness, this is complicated. For firms with a 31st December year end, should the new templates for year end 31st December 21, so that means for publication in 2022, for year end 31st December 2022, i.e. capturing the data from January 22 when the new rules come in? Sorry, I haven't read that out very, very cleverly, but Oivind, you can see the actual question.
So I think the question is that if you have a sort of a December year end, should you basically, under rules presumably go live Jan 22, then will you have to report when you do your Pillar 3 disclosure in, let's say, in March or April 2022, what would you sort of put in? So I think it's, I mean, I would expect to kind of, not seen this before, that if you look at, if the reported period is prior to implementation of the rules, I think you can continue to use the old rules. That's, I think, what's normally happening with things like regulatory reporting. But I think for Pillar 3, given that's an external disclosure, there may be changes. I need to come back to to Victoria on that to confirm. But my instinct will say that there's that you can use the old rules until the new ones go live. So and it's a day before. So but yeah, let's come back and confirm that.
I think one again related point, which may be of relevance and possible benefit to our majority of our members, because a lot of our members will be covered by the reduced Pillar 3 requirements, because they'll be small and non-complex. I think the question is, in a sense, even if they don't have to, would they be allowed to early adopt the new, simpler template? So you might want to bear that in mind. So it's not just whether they have to, it's whether it actually might be beneficial to, because it would mean less work.
Yeah. No. I think you can for Pillar 3, absolutely. Earlier. Yeah. I think some firms have done that. I mean, Pillar 3 is not really it's a disclosure, but I haven't really seen regulators challenge firms on Pillar 3 in any particular way. I think it's obviously there are regulators get their data from CoRep and from your ICAP and ILAP, etc. So Pillar 3 is more what you want to to tell the market, and so some firms, they do. Some firms report a bit more than they should. There's quite I think a plethora of approaches for Pillar 3. So I think I don't think anyone will challenge you for early adopt.
Good. Question from Philip. Do we have any more details on the exact criteria for what will classify as income producing real estate versus normal owner-occupied residential lending in Basel IV, and whether buy-to-let lending is expected to be captured?
Yeah, so I mean, there is quite a lot of guidance if you go into the Basel IV rules, so the ones that sort of the future rules that go live in January 2023. So you can sort of go through what the regulators state. As I'm not sure if Philip has been through that, but there are specific criteria. I think the challenge here is that are they specific enough, and will firms be able to understand them? And I think that's probably where, and this comes back to the sort of valuation point as well. What will the PRA?
Yes.
What's their take on that? I think that's probably what I would wait for. But I think it's a really good question, because I think it sort of captures the essence. What do we know over and above what the Basel Committee is saying. So I think that's one to look out for. I don't have any more answers than what's in the rules at the moment.
That's it. I haven't seen anything since the Basel framework document was published, and
absolutely,
exactly as you say, I'm sure PRA may have to do a bit of interpreting for our context. Next question from Neil, I think we've dealt with, because this was one of the questions about valuation at origination versus index. And then we've got Mr. Anonymous asked whether are the IP, the income producing RRE, so that's the buy-to-let, etc., risk weights applicable to all buy-to-let, or is there a dependency on portfolio size? Because at the moment there's a sort of slightly different approach according to whether you're a portfolio landlord or not. Similarly, is there a view on buy-to-let limited companies? Is it the case that any lending not to an individual might have to be classified as income producing regardless of portfolio size, because it's not to an owner-occupying individual?
Yeah. Again, I think that's a really good question, and I think there are some guidance on this in the Basel IV rules. What's there at the moment, but I think again we have to look to the PRA and say what they come out with in terms of more specific guidance. I know, for example, for portfolio landlords, there's PRA specific guidance for that at the moment, and so I will expect something similar like that would happen. So I hope that when they start the consultation on that, we'll get more clarity from on the IP RRE risk weights.
And there's one question that actually came in via chat, and it's also on the standardized approach and the residential real estate. So in two parts, we've dealt with the question about the original valuation, where we don't know any more yet. We're waiting for the PRA to show its hand. But the second part was on determining the LTV. Do you take loan amortization into account, even if you have to keep the valuation at the original value?
That's again, it's really good. It's a really good question. I think from memory, I need to double check that, but I think you can take loan amortization into account. I think that's one for me to come back, back to you on. I think there's a couple of the questions there. I think I need to do a bit of research and come back, but I think it's you can take it into account. And
last question at the bottom was from Charles. Any guidance on unrated counterparties under Basel 3.1, Basel 4?
Yeah, there is. I think I think it's quite similar to the current rules. I think in terms of unrated counterparties, there are some, I think, slight differences, but I think you typically sort of end up with a sort of 100% risk weight territory, if you like, for example, for your corporate exposures and so on. But there are some additional changes, I think, around sort of, you know, which jurisdiction is that counterparty, an unrated counterparty in, for example, you know, which asset class. But there's nothing, you know, fundamental changing in, you know, in that stage. I think where you will see more changes is on the rated counterparties, where there's more sophistication, basically based on the kind of the credit risk ratings, and there's new risk weights. So yeah, not too much, I would say, on that. But that's, again, it is in the rules, and if you go into the rules, you'll see all the detailed analysis for that, but nothing sort of major changing at all.
Right. Okay. I think just looking down the list, I think we've covered all the questions that have come in, both via chat and via Q&A. And it's now just after 10:30, so we've run for the full hour. So I think that's a good signal, because I know you'll all be very busy with other stuff to do, that we'll come to the end of the webinar. And I'll just share a couple of final thoughts. So I'm delighted that we've managed to answer all the questions that came in today, but I know that Oivind has kindly agreed to follow up directly with one or two on specific questions, but thank you for all taking part. That was really good. It's a good sign that we were dealing with stuff that really matters. And as mentioned earlier, we are recording the webinar. It will take a few days to get it all ready and loaded up onto our website, but it will be there before long. Beyond that, I think all it remains for me to do is to briefly thank, in the background, Rima and Lara, who've been doing all the work behind the scenes, and then particularly to thank Oivind for a really useful canter through the horror scope landscape of Basel, and try not to be too disappointed and upset by it, but in the end it won't be too bad. We'll kind of survive somehow. And on that note, to say thank you all for taking part. Good to see you, even if you couldn't see us, or other way around, and enjoy the rest of today, and we'll close at that point. Talk to you again soon. Bye.